Welcome to the Market Huddle Plus. I'm Kevin Muir, and it's my great pleasure to welcome back to the show Vincent Deluard, Strategist of StoneX. Vincent, thanks for coming back.
It's always a pleasure. I think we picked a great week to speak, and I'm very happy to be back.
Well, you know, my problem about having you back is I go read all your stuff, and I think to myself, man, this guy is so smart. He says he believes everything I believe. So it's a little too much confirmation bias. I'm going to just start with a quote here because I thought it was absolutely fantastic. You wrote, in the 2010s, inflationary growth was the dark side of the moon, the quadrant upon which light never shone. Since the COVID Great Reset, deflationary busts have become the dark side of the moon. Because of massive deficits, secular inflation, and the demographic trends, nominal GDP growth will not turn negative and the unemployment rate will not rise above 7%. Could you expand on that and explain your new thinking about how the moon is actually rotated in your view, and we have a new area, a new quadrant that the dark side will never see again?
Cool. Yes. So let's start first with the Pink Floyd album, The Dark Side of the Moon. Fantastic album, and it refers to a side of the moon we never see. There's a side of the moon that's always in the shade. I think it's the shade of the Earth. And I was applying that to the concept of quadrant investing. So for those who are not familiar, this is kind of a staple of global macro. It's basically a two-axis framework. On one axis, you have inflation. On the other one, you have growth. And you divide the economic regime based on whether growth is above average or inflation is above or below average. So yeah, that gives you four quadrants. One, the ones at the best for asset prices, deflationary growth, right? Prices are going down, output is going up, everything's great. One, to the right now, is the inflationary boom, which I think is what we've been in pretty much since COVID. I mean, there were shifts, but overall, I think we've had an inflationary boom where we've had both high inflation and high real growth. And then we keep turning clockwise. You hit the stagflation quadrant, where your growth is disappointing, but inflation is still very high. This was very much what we had in the 1970s when people talked about the misery index, right? High unemployment rate and high inflation at the same time. And then you go to the bottom left, which is something probably like the 2009, 2010 period, which is a deflationary bust. Output goes down and inflation goes down as well. So the thesis that I was suggesting is that this is the new dark side of the moon. We will not experience disinflationary or deflationary bust in the 2020s in the same manner that we never experienced inflationary booms in the 2010s, and for pretty much the opposite reasons: demography, fiscal spending, and monetary policy.
That's great. And one of the things that I was struck by when you said this is that you have this opinion, and it's actually playing out in the market in real time. We're seeing this, and yet everyone keeps thinking that we're going to go back and play go back to that other quadrant. And I was wondering whether you've experienced the same thing, and what the pushback is when you tell people, no, that quadrant you need to think of is forget about it, and wonder why you think they're so torn to believing that quadrant is what we're going to experience any day now.
I mean, I think part of it is the built-in memory of quant models, that and availability of data bias. You have a lot more data for the 2000s and 2010s than you do for the 60s, the 70s. So I think a lot of strategies are naturally kind of pulled. I mean, any model wants to revert to the mean, right? So I think that's part of it. Quant models want to go back to what they think is normal, even though, there is no normal. I mean, there's just, different regimes at different time. And then the second is, I think, a institutional bias towards rate cuts, right? I mean, we want rate cuts yesterday. I think pretty much everybody in our industry, or not everybody, but a lot of people in our industry benefit from rate cuts. They have high leverage. They have they're very asset heavy, so they want the Fed to cut. And the best way to convince the Fed to cut is to tell them that a depression is around the corner and that they will repeat the mistake of the 1930s of keeping monetary policy too tight and then leading to a Great Depression, even though, in my opinion, it's not a risk. I mean, I'm going to be a little provocative here, but I was actually thinking that, like, when is the last time we had a true recession in the U.S.? We can't call COVID a recession, right? We completely self-inflicted. I mean,
right.
if you shut down the economy, yes, output will drop, but that's not a genuine recession, right? So then you have to go back to 2009, but then again, we don't call it the recession of 2009, right? We call it the Great Financial Crisis. This was not a recession in the way we experienced recession in the 19th century, early 20th century, in the sense that there's too much industrial output. It was an accident that was caused by excessive leverage. It was not kind of the natural economic cycle. Then you have to go down to 2001, but was it even a recession in 2001? I mean, it was very soft. And then we had, 9/11 that kind of acted as a trigger. So I guess that brings you back to 1995. And then again, it was kind of a softish landing scenario. So to get a true recession in the way like a 19th century economist would have thought about it, something that comes from the business cycle, you have to go back more than 40 years ago. And I think that tells you that, yeah, we are probably in a different environment where we're going to have a few recessions. And I think that's going to be increasingly the case as we get these structural deficits of 6, 7, 8, 9% of GDP, as we have a structurally tight labor market, and as we have a hyperreactive Fed.
Okay, so let's dig into this. You named 3 reasons that you thought that the moon is rotated, and let's go through them one by one. You start whichever one you feel most comfortable starting with.
Well, I'll start with the employment aspect, because in the collective thinking, I mean, a recession is basically when you lose your job, right? I think there's a quote, right? It was a Ronald Reagan, right? What is it?
It's a recession, or sorry, slow down is when
your neighbor loses your job. A recession when you lose yours, and the recovery is when Jimmy Carter gets voted out. Yeah,
I never heard that. Did he say that?
Yeah, of course. He was. I mean,
I didn't know that. I didn't know the third part.
Oh no, you should also have seen him do Soviet Union jokes. I mean, he was.
Oh no, he is funny.
Yeah,
no, yeah. Actually, the part that always amazes me about him is that one time there was a balloon that got it burst like right above him, and he said, "Missed me." And I was like, and this is a guy that had been shot, and I think it was after being shot, and he still had the wherewithal to joke about it.
Yeah. Also, Teddy Roosevelt, being shot during the speech and finishing up. I mean,
that's right.
we had some characters, but anyway, let me go back to the employment. So if we define basically a recession as a period of high unemployment, which I think is how people experience it, I don't care. You have a technical definition by the Bureau of Economic. Well, people think the technical definition is 2 consecutive quarters of declining GDP, and it's not. It is, they have some sort of a committee, I think, at the Bureau of Economic Analysis, and they look at a bunch of factors, and then they make the call 9 months after the event. So that's the gold standard of recession. I'm going to go with a recession is when a lot of people lose their jobs at the same time. And I think this cannot really happen when you have a labor market that is structurally tighter. We had this unique moment in the 2000s and 2010s when you had the 2 largest generations in the US, but broadly speaking across the developed world, working at the same time. Your boomers, they were in their 50s and 60s, and then your millennials were entering the labor force. So that created these very loose labor markets with high unemployment rate. 2010s, obviously in the US, but in Europe, you could see, youth unemployment rates of up to 50% in Europe, in Italy, Spain. So we had an oversupply of labor, if you will, which was, of course, magnified by the fact that you could outsource production very easily to low-cost regions like China or Mexico. We are getting out of this environment. The boomers are leaving, and the generation that's replacing them, the Gen Z, is much smaller. So, for example, in the 90s, I think you needed to create something like 250,000 jobs a month just to keep pace with the growth of the labor force. That number is probably around 50,000 now. So that's a huge incentive for the unemployment rate not to go up. So that's the first one. The second one is government policy. I think it's impossible to argue the contrary, that we live in a world where the structural deficit of the US has increased to 7% of GDP. And that's not going to come back anytime soon. And I mean, 7% of GDP is a huge number. I was looking at job creation. Over the past year, we created 3 million jobs, which is remarkable. 1.6 million of these jobs have been in healthcare, government, and education. So broadly speaking, your government and government subsidized sector. So when you have that level of fiscal spending, I don't really see how you can get a deflationary bust. I mean, you can get slowdown, and I suspect we'll experience one if the private sector contracts a bit, but that will not tip you under that 0% and high unemployment rate hurdle.
Can I jump in here? You had a great chart in your report that showed the deficit as a percent of GDP and then the change in growth two quarters later. Can you explain to listeners what that was?
Yeah, I mean, it was basically talking about the fiscal impulse, the notion that if you run a very big deficit, typically 2 quarters later, the economy starts to respond. I mean, when you run a deficit, you inject money in the economy, you pay wages, and eventually these wages create growth. I mean, this is Keynes 101. And now we are in a permanent state of stimulation. And the economy is responding. We are not seeing the normal effect of monetary policy, or the ones we expected are not showing up. The Case-Shiller today showed up at a new all-time high. New home sales are much stronger than they should be. Construction employment is a lot more resilient despite all these Fed rate hikes. And this is really the output of this extraordinary stimulative policy that keeps producing effects and will keep doing so.
Okay, so I happen to agree with you, but I think some of the pushback what people would say is that the majority of the spending is behind us, and that as this debt deficit and also the debt becomes more important to the electorate, they're actually going to pull back on their spending. What would you say to that?
First, I think it's not entirely true, and true probably wishful thinking. Not entirely true in the sense that, the big acts, if you refer to like the Inflation Reduction Act and the CHIPS Act, they were passed in 2021, 2022. But again, fiscal spending, I mean, if we were to compare this with dieting, I think of monetary policy as sugar. Like you get a quick high and then it goes away. Fiscal spending, especially the infrastructure spending that's in the IRA and the CHIPS Act, is more like your carbs. You feel the effect for several years. I mean, because of permitting, because of construction. We haven't spent all the money from the IRA or the CHIPS Act. I mean, this is a probably 5, 6, 7 year timeline. So we're not there yet. And then the deficit itself keeps growing, mostly because of demographic reason. I mean, the biggest expense, one of the biggest expense in the budget, three almost tied: military, Social Security, Medicare, and interest payment. They're rising. I was looking at Medicare, which is the cost of paying for the healthcare of the elderly. I mean, that's up 15% year over year, and that's going to keep growing as the boomers age and the cost of healthcare increases. Same thing with the interest on the debt. Obviously, if we stay as expecting is higher for a longer world, you're going to spend more servicing that debt, and then coming to the third big one, which is military spending. Obviously, the trend is towards more military spending, not less. So if you have these three parts of your budget that are structurally increasing, it's just impossible for the deficit to come down. And I don't necessarily want to go into a political discussion, but where is the fiscal hawks? Where are they in the 2024 election? I mean, my expectation is that Donald Trump will win. I mean, what did Donald Trump do the first time he was elected? He blew up the deficit. Right. And if we have the Democrats, it's like I was just looking at the housing crisis. house prices are too expensive. What do we offer as a solution? Are we going to give, I forget what the exact number is. It's something like 10,000 to first-time home buyers. I mean, we are in a fiscal spending mindset regardless of parties.
I couldn't agree more. A question for you. You said that Trump's going to win. Do you think that that's, first of all, why do you think that? And second of all, do you think it's an issue for the markets?
Why do I think that? Because I have eyes. and I think most Americans do. And I get the sense of unfairness from the Democrats that, based on the economy alone, and if you trust the official data, yeah, should get reelected, right? I mean, this is the Goldilocks. Krugman keeps saying that on the economy, better than Goldilocks, right? We have 3.5% unemployment rate, inflation. Well, we'll talk about that later, but you can make a case that inflation is falling, and then the S&P 500 makes a new all-time high every day. But I think at the end of the day, people just think Joe Biden is too old. They don't trust that he's able to complete his next mandate. And there is an element of maybe it's odd, but it seems that the bad memories of Trump have been forgotten. Like people have forgotten how annoying it was with the tweets and the chaos and the instability. And they still remember kind of the good economic times. They think back, 2018, 2019, life was good. And they associate that more with Trump. And then just the polls, right? I mean, you see the election is decided in 4 states in the U.S. Florida is already red. Michigan, Minnesota, the Midwest looks like it's shifting in the favor of Trump. So, just focus on the swing states, Ohio, and you see that the polling is really not close.
So in one of your reports, you actually highlighted the Abramovitz model. And according to that model, is it saying that that Biden should win? Like, are you pushing back against it and saying that this fellow's got it wrong? Because usually, if the economy is doing this well, the incumbent it's a cakewalk.
Yeah, and that's what the Abramovitz model says. That's what a lot of the kind of more quant-oriented political pundit would say, is you should just look at the data. It should be a complete blue wave. I just don't think that's the case, because there is this. I mean, we've never had actually 2 presidential candidates so old, but we've never had. I mean, by the end of Reagan, you had signs of decay, but he was already, he didn't run for the 3rd term. I mean, he couldn't. It's as if Reagan had run for a 3rd term, I guess, where you see this kind of decay. And then I think about the economy, there is a vibe session idea, right? The view that the economy is not perceived to be as good as the numbers tell. And I think that brings me back to the concept of shadow inflation. I think you have these issues with the way the CPI is being measured, and the public is certainly not feeling the disinflation and the view that the inflation's dragon has been slayed is not at all something that's prevalent, and for good and bad reasons. But I think generally inflation is really a political killer. Because it's felt by everybody. The unemployment rate, as long as your neighbor is unemployed, you're okay with it. But inflation is something that everyone feels, and people typically express that anger at the voting booth.
So you might push back on the Abramovitz model and say that, again, what you were mentioning earlier about it being based upon a period when there was mostly disinflation and wasn't, the model is based upon data that we didn't experience. Like, we haven't had this sort of persistent inflation in many decades.
Absolutely.
All right. So let's talk about inflation. First of all, we've had a little bit of a fallback for a little while. It seemed like the Fed was going to hit its target. We thought that we were well on our way to 2%. And over the last month or two, it's hooked up, and then maybe it's, not quite as easy as all the kind of disinflationists believe. And I was wondering what you think it's going to do in the coming year, and how maybe to position portfolios based upon that.
Yeah. So I I'll go back a little bit further and go back to the summer of 2021 when it was said that the spike of inflation was going to be transitory, right? The T word. And I think we need to apply the same lenses about the fall of inflation in 2023. It was, there was an element of the spike of inflation that was indeed transitory. The used car prices almost doubling, airfare, supply chain shortages. The spike from, let's say, 4 to 9 to me was a bit of an illusion. In the same way, I think the fall from 9 to 3.1 in the summer is also maybe not illusory, but the product of luck. We are fantastically lucky in 2023. I mean, China reopened. Everybody thought that was going to be a demand shock, that the Chinese would do what every other country had done at the reopening, which is hit the mall and go on a vacation. And instead, the Chinese
hunkered down.
Yes, yeah, they curbed demand. Very restrictive policy when it came to new construction, trying to delever the housing sector, and at the same time, they subsidized supply. If you look at the growth rate in loans, most of the new loans went to industrial, the new three, right? Electric vehicles, solar panels, and batteries. So China, the reopening of China, which everyone thought would be inflationary, turned out to be disinflationary. And that was, of course, fantastic for Jay Powell. I mean, he collected a Chinese dividend, if you will. So that's the big one. The supply chains got easier. The base effect got easier. So inflation fell, and to be honest, it fell more than I thought it would. I did not expect it to go all the way down to 3. But now we are getting to the point where it's gonna require the same kind of luck to get to 2. And I doubt that it's going to come. Your base effect are starting to work against you. Gasoline prices are a big problem. Shelter, I think, is the big one, and I think that's a mistake on the deflationist one. The deflationist think that shelter is going to keep falling, and it's not. If you look at the January to February CPI, shelter is kind of hanging out at around 5%, which I think is reality. I mean, real estate prices are not crashing. The Case-Shiller is at a new all-time high, and I would argue we have a lot of accumulated lag towards shelter inflation. If you plot the shelter component of the CPI versus the Case-Shiller, we're running 20 percentage point behind. I mean, when are we going to catch up with that? So if shelter doesn't cooperate, if you do not get your core goods inflation as much as you used to, you go back to basically your sticky core services, which is essentially wages. I mean, I'm obsessed about the wages of hairdressers in this country because I find that's to be the most. No, hairdresser is.
I don't have this problem, Vincent.
That's awesome. Well, if the price of a haircut has been rising at a plateau of about 5% for 3 years now. And first of all, I think that's a great thing. I think hairdressers should be making more money. It's a tough job. You can't automate it. And, in general, I think, low end service workers have had the short end of the stick for far too long, and it's well time to catch up. But what that reflects to me is the marginal cost of hiring someone without a college degree. I mean, all that goes into a haircut is pretty much labor, right? There's very little in terms of productivity. There is no supply chain. There is no Chinese chips. There is no Russian gas. It's just a pair of scissors and a worker.
Okay.
And my view is that this, and I don't just do the hairdresser. I look at the dry cleaners, the waiters, the hospital workers. And you see these wages rising by 5.5% for 3 years now, from 3% before COVID. And when you had 3%, that was consistent with 2% target, right? 1% productivity gets you to 2%, right? With wage growth. With 5% wage growth and 1% productivity growth, that gets you to a 4% target. I think that's where we reset. I don't necessarily think that that's a bad idea. I think the economy can just adjust to it, but I don't think the asset prices and certainly not the rates have adjusted to this reality.
Well, that's a great point, because I think too many people assume that because something like inflation ends up being a little stickier than things people think that that's bad for the economy, whereas it actually might be better for the economy because to the extent that labor has lost as a percentage of GDP for the past 20, 30 years and has just been going down and down and down, at least, we can stop that trend and send it back up. But what do you think that means for the stock prices if we do have higher inflation?
This is the hard one, and I must candidly admit that I would not have expected the S&P 500 to be at 5,200 something today.
Yep.
You can make... Okay, you can say very, very clearly that inflation, the worst asset to be in an inflation environment is long-term treasuries. And that quote has worked. It's the dark side of the moon argument, right?
Okay.
In that quadrant, since you never visit that quadrant and the only asset that does well in that quadrant is long-term treasuries, you avoid that. And that's worked beautifully. You could also say that some of your, with a lot of volatility, but, inflation hedges have worked quite well. Energy has been a good sector. Gold is making new highs. I don't know where you want to put Bitcoin, but we certainly see the inflationary stuff doing well. Stocks is always a harder question because stocks, you can really make. At the end of the day, it depends on the stance of monetary policy. Stocks are a real asset, right? So you have. Yep. You have a real claim on real assets, so that the value of the buildings and the land and all that, goes up with inflation. The cash flow that stocks will earn, typically, if they're able to pass through, and in my case, it's a general reset of the price level, so there was going to be pass through, are going to grow with inflation. So you can make the case that stocks should not be affected at all. You can even make the case that at the beginning of inflationary period, stocks benefit from inflation because of the way we depreciate assets. If you depreciate assets at the price you paid for them, so that would be the FIFO method, first in, first out, you depreciate the asset at a lower cost than it would cost to replace them, so your earnings are temporarily boosted by that. I think maybe we saw some of that in 2021. So you could make a case that stocks as an asset class do not underperform during periods of high inflation. And historically, that's been somewhat true, right? If you look at the German stocks in the great inflation, the Weimar Republic, Turkish stocks, for the past 3 years, Turkey's been the place to be, No, but better than the Max 7. Go buy some Turkish stocks. So yeah. But what I'm going to say is we also have the memory of the 70s when stocks had a horrible decade in real terms, because eventually, we had Volcker, the Fed hiked to 16, 18%. And of course, that destroys your multiple. So if you think that the Fed is completely going to let go of inflation, yeah, probably you should buy stocks. It's not my case. I think they still need to put up a fight for it, and I think the market is kind of discounting that, not thinking through what it would mean for this kind of new normal, where you have neutral rate is around 5%, and then with some sort of term premium, you tend to 10 years at 6-7%. I don't understand how we could have a 22, 23 multiple on stocks in these conditions.
So your argument is that the equity risk premium has gotten too rich.
Yes.
And then eventually, and does it take the long end of the bond market to go to that 5, 6, 7% before stocks really have any trouble?
I think so. Last time we went to 5, it's really on the 10-year. I'm talking like it really. Okay. Yeah. You started to see these big sell-offs in the stock market every time the 10-year rate yield touch 5%. So yeah, maybe we have a little bit of buffer. I also think that the more time passes, the higher the tolerance, right? It's almost like a drug if you think about it. Like, you build a little bit of a tolerance. Like 4 years ago, you'd have to, like in 2018, the Fed could not raise rate to more than 2.5% before, all hell broke loose. 3% was the now we're talking 5. We tested that a couple of months back. Maybe now it's going to be 5.5. Maybe the economy is building resilience to these higher rates.
Isn't that just a function of the fiscal and all the positives that you talked about?
Yeah, I think so. It really matters.
Okay, and so my next question is the yield curve. So the yield curve has consistently been kind of sending a signal that the economy is about to roll over, and yet it hasn't. Why do you think that the yield curve signal is broken?
Oh yeah, absolutely. I mean, we've talked about this many times before. In a way, I think it's the yield curve is what keeps the economy going to some extent. I mean, because the yield curve is inverted, investment grade yield in the US is probably around 5% right now. So less than the Fed funds rate. I don't think that ever happened that, you take credit risk, but you get less.
You earn less than you could earn in
Yeah.
the Fed, leaving it, rolling it at the front.
But that's the reality now. And that means that the stance of monetary policy is accommodative. I mean, we have, let's call inflation 3.3, with probably that's where it's going to print next month, 3.5, something like that. GDP growth is around 2 and 3. So yeah, that gives you nominal GDP growth of 5.5%. And when companies get to borrow at 5%, I mean, that is the very definition of easing monetary policy. You pay less on liabilities and the economy is growing. That gives you an incentive to lever up. And you see that if you look at bond issuance. I think we had a record for high yield issuance in January. You see the private debt market is extremely strong. So again, it's one of these cases where you don't need a model for R star. You just need eyes. You just need to see the actions of market participants clearly tell you that monetary policy is not restrictive at 5.25%.
Could you almost also make the argument that part of the reason that the equities are doing so well is because they continue to be able to issue those bonds, and this mispricing of the yield curve is driving the outperformance of stocks, which is kind of ironic because usually people would view the opposite. Usually they'd say yield curve stops the economy, therefore you don't buy stocks. And in fact, it's doing the opposite here.
Absolutely. And that's the yield curve. The inverted yield curve is the problem. And I kind of agree with the suggestion that was built in your question, is that the yield curve will need to steepen before we can have, and I'm not even sure we're going to have a recession, to be honest, but a more meaningful slowdown, which is going to be extraordinarily confusing because we've been trained to think of an inverted yield curve as a sure sign of the recession, and of a steeper yield curve as a sign of better economic conditions. I think it's going to play out the exact opposite this time.
Do you worry about a UK style like bond, the long end going no bid, like an event in the bond market?
Yeah, I've worried about that. It's hard for me to get data, but we saw bits of that, right? There were days when you could see the 10-year yield like jumping by several basis points, for 3-4 days in a row, which kind of indicates of some supply and demand problem, especially as I mean the issuance at some, I think we've solved the problem. We put a bandage on it by really just financing the treasury at the front end, and maybe that keeps going. But at some point, you're going to see the need to tap for the long end. To tap the long end. The Fed has kind of communicated that it's not very happy with its current portfolio, where it's got too many coupons, not enough bills. So I think if the Fed is going to help, it should be at the front end. So it's one of these scenarios, I think, that could indeed kind of end the bull market, would be long-term yields kind of going through the roof and not being controlled.
One of the things that I've kind of pushed back on the Fed, and I find too many people often are too quick to shit all over the Fed. And I think that they pick the wrong things to be mad at them for. But one of the things that I definitely believe is that when he was raising rates, 50, 75 a crack, in the heart of that kind of panic about inflation, I think he should have been doing less rate hikes and more hitting the bids on the long end of the bond market. Do you feel the same way? Like, have you ever thought about that? And like, I guess it doesn't really matter because we have to trade the market in front of us, not the one that we wanted. But I really think that is the
so let me rephrase to be sure I understand what you're saying. You're saying that the long end matters more economically. So if what he wanted to do was to slow the economy, slow inflation, he should have tried to increase long-term yields more so than short-term. That did not matter as much, right? That's your argument.
Yeah, because and to some extent, by going and raising rates, he might have slowed the economy more, and then we wouldn't have had to be as high in terms of raising the rates.
Right.
And I actually believe that in terms of him raising the rates and the fact that everyone is already locked in their duration and the corporations and the homeowners, that the economy is actually less sensitive to his raising the rates than he understands.
Absolutely.
And in fact, when he raised the rates, the government didn't change their behavior, yet had to pay out more interest. And it was actually could have been stimulative. Like he actually might have been increasing the economic activity by raising rates so quickly.
Yeah, I know it's kind of an MMT Warren Mosler argument. And I mean, there is a part of me that believes it. I mean, you see that in Argentina, by the way, where, when you increase the overnight rate to 50%, I mean, you just make the Argentinians who own T-bills super rich. I mean, the budget, the budget becomes a function of the interest rate. And maybe we're getting there in the US. Maybe also as we shorten the duration of the debt, effectively when you raise rates, you stimulate the economy. I mean, that is an argument that is plausible.
Now, do you think he's going to be able to raise rates though? Because although I kind of pushed back when the market said there was 6 rate cuts priced in,
right?
And I do believe he, in his heart of hearts, he wants to lower rates. I'm not sure he's going to be able to, depending on what inflation does. But one thing I'm convinced of is that if we get into a situation where the market is actually demanding him to raise rates because inflation is taking off in front of the election, I think I don't know if he's going to be able to do it. And actually, that's the scenario I worry about.
Yeah.
Do you think he's going to be able to raise rates in an environment? Let's just say, I know it seems crazy right now, but let's imagine inflation turns and, gasoline keeps running, oil keeps running. Next thing we know, it's September and inflation's back up to 4%, 5%, and he should really be raising rates. Do you think he's going to be able to do it?
I can certainly see the scenario. I mean, especially as, the way the base effect are going to work. I mean, we're going to hit the 1-year anniversary of the through inflation in July of 2024. I've done a lot of work on long inflation cycles, and typically inflations come in waves, and it's a 2-year sine wave, if you want. So and we're tracking perfectly, right? Your peak of inflation was June of 2022 at 9%, or June or July, I can't remember. Your bottom was so that's the bottom of the sine was July of 2023. That would mean that the next peak is going to be June, July of 2024, which would mean completely consistent with scenario when everybody freaks out and we need more rate hikes. I don't know. I think I agree with you. His bias is towards cutting. He's given the market a lot of hints, breadcrumbs. Probably not as much as the not of course 7 was crazy. Now I think we're down to 3. I think the SEP, the Summary of Economic Projections, has 3 or 2. I can't remember. 3, I think.
I think it has 3 right now.
Right, and they're gonna move that.
But we all know that's kind of BS. Like it's pretty arbitrary.
Oh yeah. But maybe that's a way they can communicate something without. You know what I'm saying? Like instead of to not do a complete cop out.
Right. Okay, so they do that, but okay, so let's just imagine for a second that this occurs. We have raising rates. The Fed pulls back on the amount of cuts, and let's just say they start communicating 0 cuts.
Right.
Okay. So would you think that stocks, although they might stumble over the short run, because they're, let's face it, they're stupid overbought and
Yes.
they're due for a pullback. But ultimately, that's not a problem for stocks. Would I be correct in saying that's how you would interpret that?
I mean, if it stays in the front end, yes. I mean, if we maintain the framework that we've had for a year and a half now, where the cuts are not, we don't get the cuts, but we're gonna get them next month, right? So
Right.
it's like it doesn't matter, right? What's 25 bips? I mean, nominal GDP is running at at 6%. Everybody's refinanced. That doesn't change the grand scheme of things. So
So your concern is the long end.
Yes.
So they lose control of the long end. That's what you're worried about.
Yes.
Okay. I'd love to talk about your 3-quad portfolio. It's a fascinating kind of exercise, and I think it's something that would be really helpful for people to understand. Why didn't you explain to people what it is and how it works with your dark side of the moon argument?
Sure. So going back to the quad conversation, it's a 2x2 matrix, right? Growth on the y-axis, inflation on the x-axis, and you divide the economic regime in 4 quads: inflationary growth, disinflationary growth, stagflation, and then depression. And each quad has an asset that performs best. So when you have disinflationary growth, typically it's your tech stock, your growth, your NASDAQ, right? Because inflation is going to be low, so that means rates are low, and this helps them because they're long duration. But growth is very strong, so that they're getting both the growth asset and the duration effect helping them. During inflationary booms, when you have both high inflation and high growths, you want to be in energy, commodities, and then value stocks, emerging markets, things like that. During your inflationary bust, your stagflation, really, gold is the only game in town. And then when you have a deflationary bust, you want to be in long-term treasuries. That's the only thing. It's a risk-off asset. So my idea with the 3-quad portfolio is that it's actually kind of hard to identify where you are in real time, because you don't see GDP until almost 2 quarters in arrear. You see inflation with a month in arrear. So you're not sure where you are at any given time, and you're not sure where you're going to go either. Instead of spending too much time focusing on where you are, know what you're not. And I think that's a lot easier to identify. That in basically pretty much every decade, there is this quadrant that is the dark side of the moon. In the 2010s, you couldn't, it's kind of hard to tell where you were in the recovery, or if the recovery was going to stumble or not. But you could be pretty confident that we're not going to have an inflationary boom in the US. So that was the dark side of the moon then. And indeed, in the 2010s, the stuff like commodities, energy, EM, value stock were absolute dogs. If you build a portfolio without them, you would have outperformed massively. I think that in the 2020s, it's the exact opposite, right? Maybe the economy will slow more than I think, and will move towards this from an inflationary boom to stagflation. I'm open to it. It's possible. Maybe we're very lucky, and commodity prices pull down, China slows down a lot, and we have a disinflationary growth moment. I think all 3 quadrants are possible. My base case is that it's going to be somewhere between inflationary boom and inflationary bust, but I'm open to the 3 quadrants. One that I think is very unlikely is the deflationary bust, for the reason we talked about. So that means that you build your portfolio without the asset for that quadrant, which is long-term treasuries. And just by doing that, in my back test, I found that by avoiding the worst, you actually outperform massively with cutting a lot of the volatility from a kind of traditional diversified portfolio.
Yeah, it looks like a terrific chart. So you're long tech stocks, energy stocks, and gold. And you compare that to the traditional 60-40, and it's crushed it.
Yeah.
And I love that line, know where you're not.
Exactly. This is the Delphic injunction, right? Know what you are. I think it's more important to know what you're not. Actually, maybe it's more important to know what you are, but it's easier to know what you're not.
That's great. So Vincent, you know what? Thanks for being with us. Why don't you tell people that are interested in your work where they can get a hold of you and how they can get in contact?
Well, the best way, of course, is Twitter, or now known as X. My handle is at Vincent Deluard, VINCENTDELUARD. I do not post like a maniac because a lot of times many times I have no reaction. Like I admire people who have things to say about everything. I mean, there's a lot of stuff I have no opinion about.
Admire is the right word there.
No. You have guys who are legitimately good at it. Like legitimately, like people I admire, people who are friends of mine. I'm like, man, how can you be, so quick and so witty, like a Brent Johnson, man, he or a Luke Groman or a Mike Green, like these guys are like quick and 90% of the stuff is really sharp. And I'm like, wow, how do you do that? I'm not like that. But I try to post things that I think are important. And I try to post things that I think are original, where I think the consensus is missing something. So Twitter is the best case. I look at it. I do not post, but I do look at it. And then, of course, for the clients or prospect of StoneX, we are a Fortune 100 broker dealer. We are very active in pretty much every asset class. So the best way really is to, if you're not on my mailing list, you talk to your sales rep. You say, hey, I want to get Vincent stuff, and we'll get you on it. And then if you are not an institutional trader or client, the best is also podcast. Obviously, I love being on the Market Huddle, and I'm going to try to do more because this is really been a fantastic tool for educating yourself and learning from other people's mistakes.
So for institutional clients or institutional clients that aren't yet clients, they can reach out on Bloomberg and ask for your stuff. Vincent, I love reading it. And as I say, it's a little bit of a problem because it's so much confirmation bias for me, but your ability to put it into words and know what you're not, and to talk about that quadrant that you think is being now the dark side of the moon, I think is the best example of your type of out of the box thinking. And I just want to thank you again for being on our show.
Always a pleasure. Thanks, Kev.
Take care.